In my previous article on Nvidia Corporation, I recommended a buy rating, asserting that the stock was overvalued at the time. However, due to the recent export restrictions imposed by the Biden administration, I decided to make my conservation model more conservative by subtracting the annual revenue from the Chinese market. The result is a new price estimate of $414.50, just 2.1% lower than the stock's current price of $423.25. Despite this change, Nvidia still has a lot of potential to generate huge returns every year, and my price maintains a good margin of safety. All things considered, I reiterate my buy rating for Nvidia. In my previous article on Nvidia, I recommended a buy rating based on my estimate, which is about $20 billion below analyst expectations. The product is trading around the exact values of the model I suggested, and the price is in line with my assessment. Nvidia's stock price is monitored according to my plan until negative news comes out. Chips produced by Nvidia for the Chinese market are no longer suitable for export. Analysts estimate that China accounts for about 25% of Nvidia's revenue, a huge margin. For fiscal year 2025, analysts predicted that Nvidia's revenue will reach $79.39 billion, while for fiscal year 2024, the forecast is about $54 billion. In terms of net income, analysts expect EPS of $10.90, equity of $27.13 billion, given the number of shares outstanding. For fiscal 2025, analysts forecast EPS of $16.66, leading to an estimated net worth of $41 billion. Since Nvidia has not revealed its third quarter results, the financial indicators I discussed in my first article on Nvidia are still relevant. As shown in the table below, China provided $4.3 billion in funding for the first half of fiscal year 2024. When this figure is divided by the total revenue received during this period, it shows that Nvidia made about 20% of its sales in China. The main risk to Nvidia's optimistic outlook is the potential for an economic downturn. Such a reduction can reduce the investment of AI and affect the game aspect. While projecting $56 billion in gaming revenue by 2028 may seem ambitious, any excess could be transferred to support other sectors such as data centers and automobiles, which may be underestimated, and my calculator Nvidia's financial stability is strong, characterized by low debt and high cash flow. In the short term, a decrease in the stock price may occur due to overestimation. However, this should not be a big concern because it allows investors to get more shares at a lower price. Finally, my analysis demonstrates the stability of Nvidia's financial outlook, even in the face of unforeseen problems. The plans I keep, already under the agreement of market analysts, continue to reveal attractive investment opportunities. With a fair price estimate of around $548.29, representing a strong 29.54% from the current stock price of $423.25, and a future price estimate of $1,658.85, giving an annual return of 32.9%, it is clear that Nvidia has great growth potential. It is important to note that my variable strategy leaves a margin of error, providing a margin of safety for investors. Therefore, I maintain my consistent buy rating on Nvidia. Citing its continued financial health, strong market presence, and potential for significant returns. While external risks, such as economic downturns, are always present, Nvidia's well-diversified business model, along with prudent financial management, allows it to face these challenges head-on. Like that. In addition, the current stock price may have fluctuations in the short term. But this can be viewed as an opportunity for intelligent investors to improve their position and take advantage of Nvidia's long-term growth. In early October, I shared my bullish view on PayPal, considering it a buy. Following my recent earnings report, my belief has been strengthened. The latest earnings conference call hasn't had any big surprises, with earnings beating consensus expectations. These results correspond to a discounted earnings growth rate of 8%, yielding a fundamental stock value of $80 per share. Apparently, PayPal has undergone a management change, with Alex Chriss taking over as its new CEO. With the arrival of a new CFO, Jamie Miller, and a new CTO, Archie Deskus, the company appears to be ready for a positive change. The new president, especially during the call received, focused on growth and efficiency. His extensive experience in SMEs and empowering independent entrepreneurs is promising. During the earnings conference call, the new CEO announced a clear vision for PayPal to improve its performance, thereby increasing profits and margins. Given PayPal's current PE value, I see high upside potential in the stock. There is a disappointing trend in PayPal's growth going forward, between what seems to be a plateau in the acquisition of new customers. PayPal is constantly fighting to expand its user base, with a 0.9% annual decline, resulting in 428 million active accounts. Management says that the slow outflow of low-end customers, mainly from Latin America and Southeast Asia. Despite assurances that the exodus will have little impact on payout ratios, the continued loss of customers remains a persistent concern. Despite the challenges, PayPal's growth strategy remains promising, providing ample opportunity for expansion by capitalizing on its existing customer base by introducing additional services and driving increased purchasing activity. On a positive note, the third quarter saw a commendable 11% increase in the number of transactions processed through the PayPal platform, a total of 6.3 billion. This increase effectively offsets the decrease in the number of employees. Of note is a 13% year-over-year increase in business per active account, reflecting a continued upward trend through Braintree's growth. PayPal is struggling with obstacles from an unpredictable economic climate and high interest rates. The company's leadership is facing a tough test with growing competition from fintech giants like Google Pay, Square and Apple Pay. The recent leadership change at PayPal introduces an element of uncertainty, raising questions about the company's ability to maintain a strong brand presence and retain a large base of consumers and customers. This puzzle adds complexity to its look. Additionally, the changing regulatory environment, particularly regarding transaction fees and buy now, pay later services, presents potential operational challenges. Although PayPal undoubtedly has a great impact on the market, these challenges have many factors that require careful attention from investors who are evaluating its future. In summary, a comprehensive analysis of PayPal's current situation reveals a mix of challenges and opportunities. While there are obstacles such as reduced operating accounts and corporate challenges, positive indicators such as reduced operating expenses suggest potential change. DCF and sentiment analysis provide many market ideas. Looking ahead, with a new CEO at the helm of the restructuring plan, one can expect that the investing community will recognize the high value of the current stock. Positive changes are expected in the coming year, calling for vigilance in looking at PayPal's approach. Armed with this knowledge, entrepreneurs can navigate the difficult landscape with a subtle understanding of PayPal's potential for growth and returns.